5 steps to making a profit in crude oil trading. Crude oil trading offers excellent opportunities to profit in nearly all market conditions due to its unique standing within the world's economic and political systems. Also, energy sector volatility has risen sharply in recent years, ensuring strong trends that can produce consistent returns for short-term swing trades and long-term timing strategies. If you're new to our channel, then subscribe and stay connected with us by like, comment, and share this video. Here are 5 steps needed to make a consistent profit in the markets. Learn what moves crude oil. Crude oil moves through perceptions of supply and demand, affected by worldwide output as well as global economic prosperity. Oversupply and shrinking demand encourage traders to sell crude oil markets, while rising demand and declining or flat production encourages traders to bid crude oil higher. Tight convergence between positive elements can produce powerful uptrends, like the surge of crude oil to $145.31 per barrel in July 2008, while tight convergence between negative elements can create equal powerful downtrends, like the August 2015 collapse to $38.22 per barrel. Understand the crowd. Professional traders and hedgers dominate the energy futures markets, with industry players taking positions to offset physical exposure, while hedge funds speculate on long and short-term direction. Retail traders and investors exert less influence here than in more emotional markets, like precious metals or high-beta growth stocks. Choose between Brent and WTI crude oil. Crude oil trades through 2 primary markets, West Texas Intermediate crude and Brent crude. WTI originates in the U.S. Permian Basin and other local sources, while Brent comes from more than a dozen fields in the North Atlantic. These varieties contain different sulfur content and a pI gravity with lower levels, commonly called light sweet crude oil. Brent has become a better indicator of worldwide pricing in recent years, although WTI in 2017 was more heavily traded in the world futures markets. Read the long-term chart. WTI crude oil rose after World War II, peaking in the upper $20 and entering a narrow band until the embargo in the 1,970 triggered a parabolic rally to almost $70. It peaked late in the decade and began a torturous decline, dropping into the $20 ahead of the new millennium. Crude oil entered a new and powerful uptrend in 1999, rising to an all-time high at $201.40 in June 2008. It then dropped into a massive trading range between that level and the upper $50s, settling around $56 at the end of 2018. As of July 2024, it was trading at about $81.50. Pick your venue. The U.S. Oil Fund offers the most popular way to play crude oil through equities, posting average daily volume of about 2 million shares. This security tracks WTI futures, but is vulnerable to contango due to discrepancies between front-month and longer-dated contracts that reduce the size of price extensions. Trading in crude oil and energy markets requires exceptional skill sets to build consistent profits. Market players looking to trade crude oil futures and its numerous derivatives need to learn what moves the commodity, the nature of the prevailing crowd, the long-term price history, and physical variations between different grades. For more in-depth analysis and exclusive content, visit our website at financialmarkets.online. Don't forget to like this video, subscribe to our channel, and hit the notification bell to stay updated on the latest financial trends.